Hello, scholars. My name is Joseph Odge, and the topic of our discussion tonight will be uh, bonds and stocks. I will introduce them and do the valuation for bonds, and in the next lecture, we'll do valuation for stocks. Let's begin. One minute, make sure that you can see this properly. Okay. All right. So, businesses obtain funds. They always need money to do projects that can create more goods and services, and which will also generate profit for this business and for the shareholders. Now, when they want to raise this money or this fund, they don't want to touch the money they use for their day-to-day operations, because that will cripple the business. What they do is to raise this money by selling bonds and stocks in the capital market. Now, why would they sell bonds and stock? Why not go to the bank and get the money? Well, it's not always the case. Sometimes the amount that the business needs might be too much that one bank cannot finance it, or it will be very difficult to convince a financial institution to give them that kind of loan. So, in that case, they will get the money quicker by selling bonds or stocks. Let me explain more what I mean by that. Excuse me. Suppose that Walmart need 300 million to open a new branch of store. Okay. Now, like I say, one bank might be reluctant to give them this money. So suppose that now this money is big, they can divide it into 100,000 units and invite individuals to buy those units. One person might buy 50 units. One person might buy 10 units. But at the end of the day, that big amount will be reduced to small amounts that individual people can buy. That will make it easier for them to raise the money. So as soon that they say, okay, let us raise this money by dividing it into 1 million units. Okay, so we have again, make sure that you see this. It's okay. Now we have 300 million okay, divided by 1 million units. Okay, that will give us okay, let me say 100,000 units or 300,000 units. Okay, 300,000 units will be good. Okay, divided by 300,000 units. So that we have 300 million divided by 300,000 units is 1,000. So that gives us 1,000. 1,000. So one man can decide to sell bonds, sell 300,000 bonds to the public at 1,000 per value with 3% coupon. See? So what does this mean? That they have divided that big amount of money into 300,000 units and say invite people to come and buy it as an investment. So when those people buy the bonds, they are lending money to Walmart. Now, Walmart, somebody might buy 10 bonds. The other person might buy 20, might buy 5. Now, and they say that it's a per value. So that means of 3%. That means at the end of each year or every 6 months, depending on the type of bond, one month to be paying them 3% of the amount. So assume that assume that this is a 5-year bond. Suppose this is a 5-year bond. Okay. In that case, every year, and somebody bought 20 of them. That means $20,000 worth of bond. $20,000. Okay. Worth of the bond. So every year, what might we pay times 3%? That means 0.3. And that will give us okay, 20,000 times 0.03, $6,000. Sorry, 0.03, not 0.3, 0.03, $600. Okay, so $600. So if somebody who bought 20,000 worth of bond, every year, one month to pay the person $600 until 5 years. After that 5 years, one month will give him his $20,000 back plus the another payment. So this amount they pay them is called a coupon payment. Okay. See, so by dividing that amount into small units, it becomes easy for them to raise the capital. When it comes to shares, it's the same thing. They might say, okay, let us sell 100 million shares at $1 per share or at $3 per share. In that case, in the case of shares, they don't owe you. What they do is that when you get a share of the profit each time they declare profit. If they don't declare profit, you don't get a share of the profit, and that is as long as that company exists. Each time they make a profit, you get a share of the profit. Unlike bond, which is money you lend them, shares is not money that you lend to the Walmart. When you buy shares, you are buying ownership. That means you are part of the owners of Walmart. So whenever they make profit, you make profit. When they make loss, you make loss. So now having given you this background of why and how companies raise money. So they do it through issuing a bond or stocks. So in fact, corporate bonds account for more than for approximately 90% of the total new security issues since between 1995 to 2011. Now I think it will be bigger than that, or depending on the situation, or maybe about that same amount. Now, so what are bonds? Based on what I have explained so far, what is be the best way to define bond? Well, a bond is a debt investment in which an investor loans money to an entity. That entity can be a corporate entity or even government, which borrows the funds for a defined period of time at a variable or fixed interest rate. So this means that companies, municipalities, states, and federal government can raise money and finance different projects by issuing bond. For example, a local government might want to build roads, and if they don't have the money, they can sell bond, use the money to the bond to build the roads, and in the future, when they collect taxes, they pay the bonds, or they collect taxes to pay the coupon, make the coupon payment on the bond until the bond matures. Okay. So let's continue. So next thing becomes the element of bond. The par value or face value simply means the nominal value or the dollar value of the bonds that's stated by the issuer. For example, United States par value is usually $1,000 for corporate bonds. Coupon payments is the type of payment that company that the bond issuer pays to the bondholder. For example, if a bond has 8%, coupon payment coupon and a par value of $1,000. So that means it pays what is called a coupon payment of 1,000 times 8%. Let's put this there. Let's assume that I think I have done it already here. Let's say that this is a bond has is $1,000 per value and have a 3% coupon. So if the coupon payment now becomes coupon payment becomes $1,000 times 0.03. That gives us we say $30, I believe. $30. Okay. So 1, 2, 3. Yeah. 1, 2. I think it's $3. I believe $3, which is little. And you can always confirm this with your calculators. So you have 1,000 times 0.03. Oh, it's $30. It's $30. So $30. All right, it's $30. Okay. Now, if it is a 5-year bond, I mean, if the bond holder has up to 20,000 bond, in that case, the coupon payment will be 20,000 times 0.03, which is 600. So in a similar vein, the one we have in our example is somebody who has $1,000 of the bonds and the coupon rate is 8%. So that coupon payment becomes 1,000 times 8%, which is 0.08, give us $80. See? So in the United States, bonds pay interest semi-annually. That means 2 times in a year. So for somebody who has a bond of, let's say that you have a bond, somebody have a $1,000 bonds. Let's say it for semi-annual bond payments. Okay, if you have, let's say that you have $1,000 bonds. Okay, let's say $2,000 or $20,000 at 8% coupon rate. Okay, in that case, your coupon payment will be 2 times every 6 months. Every 6 months, okay, you will receive this amount. Now, it is paid twice a year, so you have to divide this 8% by 2. So okay, it is paid twice a year. So 8% divided by 2 equals 4%. Okay, which is 0.04. So that every 6 months for you having a $20,000 bond, your coupon payment will be coupon payments will become 0.04 times 20,000. Okay, so we have that okay, 0.04 times 20,000, $800. $800. Okay, $800. So every 6 months, you receive $800 from this bond. And if it is a 5 years bond, that means every year, every 6 months, so you're going to receive a total of 10 payments of $800. Then when the 5 years mature, they will give you your $20,000 back plus their coupon payment. So that is when we say coupon, that's what we mean. Now, what do we call the coupon? Because bond covenants in those days used to be have a small coupon attached to it. So you have to detach that coupon, fill it, and mail it for payment for the coupon payment. So that's why they call it coupon payment. Now, we have next thing we need about bonds. Next element that is we require is the maturity date. All bonds have maturity date when issuers are, obliged to pay you, the bondholder, the amount that you lent to them. We call it the par value or face value. So they pay you back your money plus the interest. Now, another thing is the bond covenant. A bond covenant simply means a legally binding term of an agreement between the bond issuer and bondholders. So usually they are meant to protect the interest of both parties, the issuer and the holder. So for instance, bond covenant can impose some restrictions. If the bondholders feel that the company that is selling the bond has so much debt, their covenant might stipulate that the firm maintain a minimum level of net working capital, keep a pledged asset in good working order, and send audited financial statements to the bondholders every time. Some bond covenant might have, okay, so you have this amount of bond already in your book. Don't sell any more bond until this one mature. Which means that a bond covenant can restrict the amount of debt the firm can hold, and so on and so forth. Now, let's continue. We have bond rating. Now, the same way the credit bureau rate your credit and give you a score, that shows your credit worthiness. The same way the bond are rated. Each company's bond is rated. So a bond rating is a grade given to bond that indicates their credit quality. So when the bond is rated, given a good rate, it means that that bond, the bondholder, is has a good credit, and that it will pay the bond when it is due. So the rating tells you how reliable the bondholder is. So there are agencies that rate bond, such as the Standard & Poor's, Moody's, and Fitch. These agencies provide evaluation of the bond issuer's financial strength or its ability to pay the bond principal and interest when they are due. So one thing you have to know about bond ratings is that they are expressed as letters ranging from AAA, which is highest grade, to C. C means a junk bond, which has the lowest grade. Now, different rating agencies also use different letters for rating the bonds. So, but here let's use an example from the Standard & Poor's rating, the format they use. For the Standard & Poor rating agency, AAA or AA means high credit quality investment grade. That means when you buy that bond, you are sure that the bond issuer will pay you back your money when it is due, and it will make the coupon payments at the right time. AA and BBB means medium grade quality bonds. We call it the investment grade. The same thing. It just tell you how the reliability of the bond issuer. Now, B and C are low credit bonds. We call it the junk bond. So they are risky. They are more risky, even that the bond issuer might default and you may not get your money back. But to compensate you for that, they pay you a higher coupon. So if the AAA bond pay 2% coupon, BB and CCC bond might pay you up to 8% coupon to give you an incentive to buy them. Many companies use this kind of bond to raise money fast to build projects. Then D bonds are bonds that are rated D are bonds that are already in default. That means the bondholder cannot pay. So they sold the bond, but they cannot pay the bond issuer cannot pay back the bond. They can't even pay the coupon. So that one is a bond in default. So you don't need to go to that one. That's one. So let's look at the types of bond we have. We have registered bonds. Now most bonds in the United States are registered bonds. This is because the issuer of the bond knows who the bond holders are. Know their name and the interest payment that are directly made to the bondholder. So it is easy. They do this so that they can have the interest or the coupon payment you receive from bond are taxable. So that means US want to know who you are so that they can tax you properly. And also, it's a way of preventing criminals. I mean, use people using money gotten from crime to buy bonds. Now, there's one they call bearer bonds. Bearer bonds have coupons that are clipped from the side of the bond certificates. So, and they are clipped and then they are presented like a check to a bank for payment. So the bond issuer does not know who is receiving the interest payments. Now, bearer bonds are not popular in the United States because due to their US regulation, they are not the issuance of bearer bond in the United States is, I would say, prohibited because unscrupulous investors may use it to evade taxes, so on and so forth. Then we have junk bond. I've already explained that the bond that have C grade or high yield bond. They are C grade, they are more risky, but they pay higher coupon and higher interest to attract investors. So they call it junk bonds. So they are usually issued by a company seeking to raise capital quickly in order to finance maybe takeover. The company let's say that Walmart want to buy Target, they may raise junk bonds, pay higher interest, higher coupon to attract investors, use it to now finance the takeover. Okay. Now we have convertible bonds. Convertible bonds. Convertible bond can be changed or converted at the investor option into a specified number of shares. So that means, let's say you have a bond, you bought a convertible bond of $20,000. So after some time, maybe 2 years, you may say, I don't want them to be bond anymore. Let me convert it to shares. So the company can issue you, depending on the share stock price at that time, they can say, okay, this bond is equivalent to 10,000 shares. So they convert them to shares. Now, when you buy the share, when they convert them, then you become part of the owner of the company. Callable bonds. A callable bond can be redeemed prior to maturity by the firm. So they call it a callable bond because they can be called and redeemed. For example, a decline in interest rate make it attractive for the firm to issue lower coupon debts to replace the high coupon debt. Let me explain this more. For example, let's say that this is Walmart issued a callable bonds of $30 million. $30 million at the rate of 7%. So this is like 10-year club bonds. Now, if for some reason the interest rate after the second year, interest rate went down to interest rate went down to 4%. Now, instead of paying you 7% every year for 10 years, they might, after the second year, they might say, okay, let us call the bond back, buy you off the bond, and then reissue the bond at 4%, so that they can save 3% interest. I mean, it might 3% might look little for you, but when it is $30 million worth of bond, that 3% is a good amount. So they might call it back, so pay you off, and reissue the bond for the remaining 8 years at 4%. So they don't have to keep paying you 3%, 7% every year for the 10 years. So they call it a callable bond. Okay. Next is the euro-dollar bond. So this is the kind of is a dollar denominated bond that are sold outside US. So example, if a bond that is denominated in US dollars, but it is issued in France or in UK, is a good example of a euro bond. Another example is this. Suppose a Chinese bank held dollar denominated bonds issued by a Japanese company, then this can also be a euro dollar bonds. Next is the Yankee bonds. Simply put, a Yankee bond means a US dollar denominated bond that are issued in the United States by a foreign issuer. So a foreign company came in the US and issued a US denominated, a dollar denominated bonds. Okay. So good example. Suppose this company, you all know about Nestle. It's a Swiss company. That is, what is one of the largest food and beverage company in the world. Let's say that they come to US and they issued uh, bonds in America here, and those bonds are not denominated in Swiss francs. They are denominated in US dollars. That is a good example of a Yankee bond. Then century bonds. Now these are bonds that these are not like um, 1 year, 5 year bonds that are paid that are due within 5 years or 20 years. But this one is 100-year bond. So it is that means the bondholder doesn't pay you back until 100 years. Good as companies that have issued this kind of bonds. Multi-billion-dollar companies like Walt Disney, Coca-Cola have 100-year bonds in the past, and countries, Argentina, Austria, Mexico, all these can issue 100-year bonds. But why would somebody want to buy a 100-year bond? Because you die within 100 years. Well, it is discovered that some investors have appetite for this kind of bond for several reasons. For example, a university endowment fund might find this bond appealing. After all, the university will stay for is assumed to be around for a very long time. So and you won't be needing that kind of money, needing the money. So you can buy that kind of century bond. So you keep getting the coupon payment for 100 years. Now, so investors buy 100-year bond partly because they don't expect to wait for 100 years. Yeah, some of these bonds have option that lets allow the issuer to repay the bond before the scheduled maturity. For example, a 100-year bond that Disney issued in 1993 was supposed to mature in 2093. That's almost how many decades from now? But the company can start repaying. There's a provision that the company can start repaying this bond after 30 years. So it can happen. So another reason is this: some people so investors who are doing long-term estate planning might also find this kind of bond attractive, because that means that they can pass well to their children and grandchildren, and even or the great grandchildren. Now, another reason that individual might want to buy this kind of bonds: if a company issued you a $100-year bond That means it is a good company. I mean, say, basically, it is an indicator of consumer sentiment for that company if they can buy their 100-year bond. That means you trust the company. After all, who will buy a 100-year bond for a company that did not, you don't believe that the company will exist for the next 10 years? Why will you buy a 100-year bond from it? So, when you buy that bond, 100-year, that means you trust, you are convinced that that company is solid. So, the demand for this type of long-term bond can be an indicator of consumer sentiment for that company that is involved. Now we have other types of bonds, like treasury bond. These are the ones that are issued by the U.S. federal government. There are three types of this kind of bonds: bills, notes, and bonds. If the maturity period is 10 years or less, they call it a note. If the maturity date is 52 weeks or less, or 1 year or less, call it a treasury bill. But if the maturity date is bigger than 20 years, we call it treasury bond or T-bonds. So treasury bond, we assume that they are risk-free because, like I said before in my previous lectures, US have never defaulted on their debt. Okay. Now we have corporate bonds. This one, and they are called corporate bond because they are issued by companies or corporations. For example, Walmart can issue bonds, JCPenney can issue bonds, and so on and so forth. Next is the municipal bonds, which are popularly called munis. So these are issued by local governments. So a local government that want to build roads, or maybe they want to establish or refurbish schools, they can sell bond and use it to do that. Now, one thing about municipal bond is that, unlike the other bonds that I mentioned, the interest you make, the coupon payments you receive, or the interest you make and you earn by buying municipal bonds are exempt from federal tax. And also, in some states, they are also exempt from state taxes if the bondholder is resident in the issuing state. So you have this advantage, good advantage for the buyer, bondholders. All right. Then we have foreign bonds. These are issued by foreign governments or foreign corporations. Usually, this kind of bonds are exposed to default risk. Some foreign governments that have defaulted, we have China in 1921, Brazil 1990. I think Brazil. Okay, Russia is the one. Russia have defaulted in 1918, 1998, and recently in 2022. Then Egypt defaulted in 1984. So these are the risk. But because of that risk, they pay a higher coupon than US bonds. I can show you this by looking at let's say bond yield by country. Okay, see. So you can see here that, United States paid only 2.97%. But look at Mexico, paid 9.7%. Look at Brazil, 13.6%. You can even get more of this. You get, see, I can see the yield. Those countries that have defaulted before, they pay higher yield. Have Russia, see, 9.3%. But compared to those countries that have never defaulted, like US and the United Kingdom, 2.98% and 2.5%. So they are more risky, but to compensate you for that risk, they pay you higher coupon. Okay, I already covered bond rating. Now let's look at equity capital, shares. Now, corporate equity capital simply means the financial capital supplied by owners of the corporation. So let's assume that you want to be one of the owners of Bank of America, all you have to do is to buy the shares of Bank of America. In both those shares, you are now one of the owners. So that share, that money, that shares they bought, as sometimes they call it stocks or shares, they come under corporate equity. So shares are usually traded at 100 shares at a time. We call it a round lot, or multiple. Now, equity securities of the corporation may be grouped into two classes. There are two types of shares: common share and preferred share, or I can call it common stock and preferred stock. Now, common stock are shares that if you buy it, uh, you are entitled to dividend. Now, dividend is a share of the profit. So you are entitled to dividend that vary in amount and may be missed. Sometimes the company might not even pay dividend at all. So sometimes they pay dividends. So, but because you buy those stock and it's common shares, you may receive a share of the profit when they declare dividend. If they don't declare dividend, you don't receive it. Now the preferred stock, this one represents the type of stock that the owners have a guaranteed amount of dividends forever. So you'll be receiving dividends each time they declare profits. You should be receiving dividends. Now, unlike common stock, sometimes you receive, sometimes you don't receive. Now, another advantage of the preferred stock is that in the event of liquidation, if the company is going out of business, now first people they settle is the bondholders or their debtors. When they settle the debtors, then they settle the when they settle the people that, yes, the creditors, then they settle the people who have preferred shares or preference shares. Then after that, if there's something left, then they can give to those who have common shares. If nothing is left, then those that have common share will not get anything. So now because of this, it's like the common shares receive all the blows when it comes to the company's problems and profit. So they don't receive. They are not being. They don't. Sometimes, many times, they will not even get dividends. And when the company is going down, they are not the priority. They are not prioritized when it comes to settling the owners. So they settle the lenders first, then the preferred shares, and then before, if there's anything left, the common shares. So as a way of compensating them for that, those that have common shares have the rights, have privileges, like they have voting rights. So they can vote to select the corporation, the board of directors. So who in turn select those that run the company. So common shareholders also vote in major issues, major decisions. Unlike the preference share does not have that kind of right. See? So because of that, they have to compensate the one way or the other. And that's why they give them that right of voting right. Now, we have different classes of stocks. So it is a way for companies to customize different classes of ownership. The most common reason for this is the company wanting the voting power to remain within a certain group. Okay, different classes of shares are given different voting rights. So this classification is based on rights. So for example, we might have class A or class B shares. For example, in a company like Berkshire Hathaway, owned by which is run by Warren Buffett, you have two classes of stocks. They are given different names: BRK A, BRK B, which is BRK class A, BRK class B. Now, so let's say that class A stock have 10 votes. I will give you an example now. The company might say that class A A stock have 10 votes, and class B stock equals 1 vote per person, per shareholder, not person, shareholder. Okay, shareholder. So if they want to make a decision, let's say to buy a new plant, somebody who has class A stock raise their hand, it can have 10 votes. Somebody who has class B stock raise his hand, they have 1 vote. Count as 1 vote. So like I said, the company use this to ensure that the voting power remain within a certain group. Maybe uh, the founders of the company may have higher voting power so that they can influence decision in the company. Okay, so where there is more than one class of stock, the classes are given A and B, and now I just explain what it is. Now at this point, I'll give you the background on what a bond is, what a stock is. Now let us proceed to the next by looking at how to price a bond. In my next lecture, I will describe how to price or value stocks and shares. So the price of an asset is the same as the present value of its future cash flows. I've done the lectures on present value. I recommend if you are confused about what present value is to go and watch that lecture. So that means the price of an asset equals the present value of its future cash flows. So that means that when we are valuing bonds, the value of the bond with annual coupon payments can be expressed as follows. Bond price equals present value of the coupon annuity plus present value of the principal. So in bottom line, let me put it this way. In plain terms, you determine the value of the bond by, first of all, calculating the present value of the interest payment, then calculating the present value of the face value, then add the two present values. That will give you the value of the bond. Okay. Now let's look at examples. The first example, I'm going to use the tabular method. So in this case, we can use the present value to determine the value of the bonds. Let me open the table. Okay. All right, we can have the table here. I think I opened too much pages now, so I'm going to close some of them. Like this one. Perhaps I can close this. Yeah, close this. So I'll close this one. Okay. Okay. Now I can share this table. So this is the table we use here. The present value table. Okay. Now you can see the present value. Now let's look at that. Some of the things we need. So in that case, the value of the bond would be VB would be interest in each of the period or coupon payment times the present value interest factor for annuity for the rate and number of periods plus the future value of the bond times the present value, sorry, the face value of the bond times the present value interest factor for rate and the number of periods. So that means I is the interest, where VB is the value of the bond, I is the interest in each time period or coupon payments, F is the face value of the bond, K is the discount rate, N is the number of periods. So the present value interest factor for annuity is PV IFA KN, which is the present value of the interest factor annuity on the bonds. Then the present value interest factor present value interest factor is present value of interest factor for the period. So so they will have so let's try question 1 of this. Uh the Brent company has 5-year bond with a face value of $1,000 at coupon rate of 10%. Interest rate is paid annually, and the discount rate for the similar bond in the market is 12%. So you say determine the value of the bond. So the first thing we do, if you remember that I mentioned that the value of the bond is the coupon rate times the present value interest factor for the annuity for the coupon payment plus the face value times the present value interest factor for that bond. So let us apply this. I'm going to take you write this thing down and take you to Excel where we can put this in, and then we'll get our answer from there. So the first thing we do is that the coupon rate is 10%. The face value is $1,000. Interest payment is 10% times $1,000, which is the face value of the bond, which is give us 100. So we are going to put all these things inside Excel, and then we go from there. So we have see. Let me write it down. Write it down. We have coupon rate is 10%. Coupon rate is 10%. So face value is $1,000. Interest is 10%. 10%. I think I wrote interest twice here. Coupon rate is 10%. Actually, the rate is care. We use care for the rate. Care is 12%. Then what else? Number of years is 5 years. So now let's go and put this in the in Excel, and then get our results. This is the first question 1. Okay, let's go and put it there. We have this face value is $1,000. Then coupon rate is 10%. Hope you can see this. 10%, yeah. 10%, which is 0.1. So the coupon payment will now become 1,000 times 10%, which is $100. Now the discount rate is 12%, which is 0.12, and then number of period is 5 years. Now this part we find this part from the table of present value for annuity. So PV, present value interest factor for annuity for 12% under 5 years, we find it from the table of annuities. So let's see. I'm going to open it for you. So you can see here the present value interest factor for $1 annuity. So at 12% for 5 years, you can see right here 12% under 5 years, which is number of periods, is 3 points. Present value interest factor for annuity is 3.6048. So you have 3.6048. You can see it from here as well. I have it on the presentation as well. You can see 3.6048. So let's go and put it in. 3.6048. 3.6048. Then next thing we need is the present value of interest factor in general, not for annuity this time. That is for the coupon, not for the coupon, for the actual face value. So we have it here as I'm talking about this part, this part now for the face value, which is present value interest factor, Kn. So we look for it here. We can now see this is for annuity. This is for see present value interest factor for $1 discounted at K%. So our K is 12%, and for 5 years, excuse me, we have it here for 5 years as 0.5674, 0.5674, 5674. I also have this in the presentation, so that you can, when you're reading it or reviewing this, you can look at the presentation as well. 0.5674. So we have it here. Okay, 0.5674. So now with this, we can get the value of the bond. Now remember that I mentioned previously that to determine the value of the bond, what you need to do is to find the present value of the interest payments, and which is the present value of the coupon payment for the annuity. Then find the present value for the face value. Then add the two present values, and that will give you the value of the bond. So let's do it now, and I also have the formula here for you, so you can see it in Excel as well. You can see them here. VB is I, which is the coupon payment, times the present value interest factor for the annuity. Annuity is the coupon payment, which is the fixed amount you receive every year from the bond issuer. Then F is the face value of the bond times the present value interest factor, and then I add the two present values. That will give you the value of the bond. So I hope you are ready. Let's do the calculation right away. So having put the information in the Excel, we can now do the computation of the two present values. So equal, remember to put equal sign in the cell in Excel so that you put the cell in the ready mode. Equals the first one is the coupon payment, which is I, which is right here, $100, times the present value interest factor for annuity for 12% and another 5 years period. Here, close it, then plus. Well, before I do that, I need to make this correction. This is not $5. This is it's not $5. This is just 5 years. Okay, it's changing it to a minute. All right. Format that cell. Just number. Yes, it's just a minor correction. Now we are ready to do the computation now. So equal, then the coupon payment times the present value interest factor for the annuity. Okay. Then plus then the face value of the bond times the present value for that amount. This is rounding it up, so I think I'm going to correct it again. I have to make sure that every cell is good. Let me format this one as well. So it's gonna be number, not dollar amount. So it's 0.5674. Okay. So with these corrections done, for some reason it's always okay. Let me make it increase the, yeah, that's good enough. All right. So I made all the corrections. Now let us compute this. Equals coupon payment times present value interest factor for the annuity. Okay, close the parenthesis, then plus. Now the face value of the bond times the present value interest factor for the face value. So we now have the two present values and add them. So now when we press the enter key, to give us the answer here, highlighted in yellow. So $927.88 is the value of the bond. And I have it here on the PowerPoint presentation as well. You can see right here, $927.88, which is the same thing I have here, $927.88. So this bond is valued. So the bondholder can pay $927.88 for this bond, and when the bond matures in 5 years, he'll be receiving the full amount, which is $1,000. Now, some of you might say that this is too small. Well, this is only for one bond. Assuming that this is for the person bought $30,000 worth of bond. So in that case, make it once you change this to $30,000, it will calculate. So I want you to be looking at this place, so that when I put this $30,000, it will give me the value here. So you can see $27,836.40. So this is how much the person paid for the bond, so that at maturity he will receive the full amount of $30,000. So what is the gain? Is, well, as a matter of fact, yeah, that's the gain anyway. Is $30,000 minus 27,000, which is a gain of $2,163 for this particular bond. Now, this is minus the coupon payment he'll be receiving every year, which is a coupon payment of $3,000 every year until the bond matures. So that when the bond matures, they will give him the face value plus this gain. So it is double gain all through. Now, that is the how to value bond using the table method. Now, the last example, I think, will be actually the second example will be how to value this bond using Excel only instead of using the table. Now, to do that, before we do that, I would like to explain what the implication of this answer. This bond has a face value of $1,000, but the value is $927.88, which means that the investor will pay. Which, as a matter of fact, it means that the bond is being sold as a premium, because the discount rate is below the coupon rate, so it is being sold at a premium. Yeah. Now, doing this the second time, the same question, but this time we use only Excel without using the table. So we call it the spreadsheet method. Under this method, the formula we type in Excel is as follows: PV in parentheses, you type in the interest, the coupon payment, number of periods, payment, future value, and type. So let me write all those things down. Then we can now put them in based on the equation we have. The face value of the bond, which is now our future value. Our future value is $1,000. Payment, the coupon payment is 10% of the coupon rate is 10%. So coupon rate is 10%. So then we have number of period is 5 years. Then interest rate is 12%. So with this, we can now go into Excel and put them in. You can see the second section where I use for my second method. So have coupon rate is 10%, which is 0.10, and the bond rate is 12%, which is 0.12. But I hope you can see this. Yeah, I think you can see it. Make sure you're seeing all. Then number of periods is 5 years. Payment, coupon payment. There's something that is missing here. Let me see. Okay, I think I have the I have to put the face value. So I'm going to put the face value here. Now, the company paying you the bond, paying you the payment, making the payment the payment represents money leaving their pocket. So that means in Excel, you have to put the cash. You have to show that it represents money leaving their pocket. When they pay you the full amount of the bond, money left their pockets, that means negative $1,000. So that the coupon payment will now become coupon rate times, in Excel, asterisk symbol represents times. That's $1,000. That gives us $100. Now it will be on negative sign because again it represents money leaving their pocket. Now for type, you receive the payment at the end of the year, and the full payment amount that you lend to them at the end of 5 years. So type will be 0. With this, now you're ready to calculate the value of the bond. Equal. Now this is the formula here. Either you use this one or you use that one. You use this one if you didn't put the sign that represents the direction of the cash flow. So that means you put the negative at the beginning. But this is the one we are using here, so we are still good. Equals present value. Excuse me. Present value. Okay. Rate is this. Coupon rate. Bond rate is 12%, comma. Number of period is 5 years, comma. Payment is $100, comma. Then future value, which is the amount that they owe you, they will pay you back when the bond matures, is $1,000, comma. And the type, as you can see here, 0 represents the end of the period. So click on 0 and then close it. That will give you the answer when you press the enter key. See, we have the same answer here, $927. It is 90 cents this time, but it's just the slight difference of 2 cents is just caused by rounding error. Otherwise, they give us the same answer, $927. So this is how to do this value bond using the tabular method or spreadsheet method. Now, next one will be an example. Now, the one I gave you is the bond, the European bond, or other bond in other countries where the payments are done only once a year. For US bonds, the payments are done every 6 months. So we have to factor that in our calculation, that the coupon payments are done and made every 6 months. So in that case, for American bond, we need to adjust the calculation for semi-annual cash flows. In that circumstance, we have that number of period will be 2 times number of years given. Yeah, that's its number of years until maturity of the bond. And the semi-annual rate will be the market rate divided by 2. So let's do this in one example. It says, assume that a $1,000 face value bond has a coupon rate of 8.5%. So coupon rate is 8.5%, and pays interest semi-annually and has an 8-year life. So if the investors are willing to accept 10% rate of return on bonds of similar quality, what is the present value of this bond? So 10% they want to accept, which is the bond rate. Now the coupon payment, because this is semi-annually, we divide it by 2. Now 8-year life, we multiply it by 2, because you're going to receive 16 payments instead of 8 payments. Then rate, which is 10%, we divide it by 2. So you should be receiving 2 payments in a year. So for this, let's go and put them in. Our put care is 10%, which will be divided by 2 to give us 5%. And number of period is 8 years, which will be multiplied by 2 to get 16 payments. So let's go and put them in and get our bond, the value of our bond. I'll take you to Excel again. So the number of payments is, I will have, number of payments will be 8 times 2. Remember that asterisk represents multiplication here. And coupon rate will be equal to, for semi-annual, is going to be 0.085, which represents 8.5% divided by 2. And discount rate will be 0.10, which is 10%, divided by 2. Okay, divided by 2. Then next is the number of periods. We have 10. Actual number of payments is 8. So I'm going to make it 8 payments. So that number of periods now becomes 8 times 2. Okay, 16. Now, let's look at the coupon payment. Before that, let's put the value of the bond, which is $1,000. To represent the direction of the cash flow, we put negative 1,000. Because for the company paying you, it represents money leaving their pockets. So that the coupon payment will equals the coupon rate times the face value, which is now the future value of the bond, which is $42.50. So type, I put 0 because you receive the payment at the end of the period, at the end of 6 months, or at the end of 8 years. Now, so equal, the value of the bond becomes the present value. Will be equals present value PV. Okay, coupon rates. Bond rate, which is 5%, comma. Number of period is 16, comma. Payment is $42.50, comma. Future value is 1,000, comma. And of course, type is end of the period is B 0 for at the end of the period. If you receive payment at the beginning of the period, it will be 1. So enter key, and that will give us $918.72, which represents the value of this bond. So the bond, you paid $918 for the bond, which is a $1,000 bond. It is issued at a face value of $1,000. So again, it's a premium bond. It is undervalued, really, actually. It's not a fact. Now, this might look small for you, but when it is a small, only one bond. Suppose it is $40,000 worth of bond that you bought. That will give you, let's say it's $40,000 worth of bond. So I'm going to change this to $40,000, and that will give you $36,748.63. So now you bought this at that price. So when it matures, you're receiving 40,000 minus that amount, okay, which is $3,251.03. That's how much you are gaining because you bought it at a discount, basically. Now, since the bond is being sold lower than the price, see, discount. You bought at a discount. Now, not only that, you have 1 minute. Let me see. I think I open this by now. Let me close this. Okay, good. Now I can get it back. Okay, good. So you get this is the gain you make from the bond plus the coupon payment they will pay you every 6 months of $1,700. Every 6 months they pay you $1,700. Then at the end of the 5 years, you receive their full amount, which is $40,000, making you have a gain of $3,251 extra. So it is a good investment. Now this is the these 3 examples that I gave you are the methods for valuing bonds. Now, a few things to note here is 2 things to note here, basically, and those 2 things are as follows. When a bond's price exceeds its par value, it is selling at a premium, and it's called a premium bond. So when the bond price has a well, I put it this way: when calculating present value of bond, we inserted the negative sign before the present value to show that the direction of the cash flow. Yeah. Now, these 2 bonds that we valued here, the first one is this one here. We got the price as $927 uh 88 cents. So, and the face value for the bond is $1,000. So it's a premium. You say it is selling at premium, so it's a discount bond. You paid less than the price. Both of them are discount bonds. I hope you enjoyed this lecture tonight, and if you do, please don't forget to subscribe to my channel, and I'll see you in my next lecture. Thank you. Bye bye.